In a world where hopium and common sense collide, starring the CryptoKeeper and BlockchainCrusader. Welcome to Debate Crypto. Crypto fam, it's your boys, CryptoKeeper, BlockchainCrusader, and new to the show is my co-host, the Crypto Baby. How you doing, Crypto Baby? Huh? Are you studying up on? We need. You know what I need to do instead of this little book right here? I need to give her the Bitcoin standard. She's actually a very advanced baby. So
$1 million idea, just throwing it out there. Baby Bitcoin books.
Baby Bitcoin books. So right off the rip, they are in there and they know all about that blockchain.
Heard it here first, guys.
Bitcoin. You heard it here first. Baby Bitcoin. Hey, so Crypto fam, if it's your first time here, make sure that you guys do all the things that YouTube wants you to do. Make sure you subscribe. Make sure you like. Let's blow up the chat. Hey, put a 1 in the chat if this is the cutest person we've ever had on the show. And if you all don't put 1s, I'm coming after each and every one of you. No, we're super excited to be here today, guys. I think we might have some great news, which might be no news. But let's Miguel, do you have it pulled up?
Let me actually pull it up.
All right. We're gonna pull it up, guys. We've got the FOMC that just met the if I could speak, the FOMC, right?
Here we go. Yeah, the FOMC. Yep.
Yeah. Okay.
Here we go. Let me know you can see my screen.
Yep, I can see it. Now let's hear it.
Let me know if you get sound. Yes, no? Yes, no?
No, Technical difficulties. Stick around. More to come.
As okay, I got it.
I might have to put my headphones on if you.
Yeah, you're gonna have to do that because then the audio is gonna be messed up.
Okay, let me put my headphones on. Hold on.
But so far, what we've heard from the Federal Reserve is that the interest rates will go unchanged. They won't back down and shrink the balance sheet until later, I think February or maybe beginning of March, and they will start to shrink the balance sheet. All right, let's see if I can do this now.
Predictable manner, primarily through adjustments to reinvestments, so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework.
All right, just make sure you.
And in the longer run, we envision holding primarily treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet
adjust the screens
in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet. And we will discuss the...
That's actually big news right there. They just finished saying that they have not decided a time frame on when they're going to start shrinking the balance sheet.
These matters...
Hey, Miguel, you've got this pulled up. You've got it pulled up.
Information at the
good.
They
sound is perfect. The only thing that sucks is that I'm hearing myself coming right back into my headphones.
We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Yeah, great job they've been doing the last 100 years in keeping price stability.
Thank you. For the first question, we'll go to Chris.
Come on, guys. Throw some questions out. Bring in the heat. Bring the heat.
Thanks, Michelle, and thank you, Chair Powell. So it's expected that the Fed will hike rates perhaps every other meeting, but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year? Is every meeting a live meeting? And on that note, would the Fed consider front-loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Great question.
So as I referred to in my opening statement, it is not possible to predict with much confidence.
Miguel, my sounds echo.
Path for our policies.
Just letting you know, for me and them.
I don't know what to tell you, man.
I'm
unless you want to share your screen, unless you want to share it. I mean,
why would what's going to be the difference?
I don't know how, because you have the amp. You can
because I
distinguish stuff. I can't do that.
Send me the link. If it was just me hearing it, I wouldn't be worried about it as much, but they're hearing it too. So whenever I chime in, they're hearing double. Yeah, let me pull this up real quick.
Sorry about that, guys. But
yeah, sorry, guys.
That was a great question. They literally just asked if they're going to be raising interest rates every other meeting or not. If they have a time frame. And from what he just said is he just finished saying that we can't really do that. They don't really have. And I've been saying this.
Were you live?
The breaks. What was
that? Were you live on that?
Live. It's okay. A live thing. Yeah. You're not sharing your screen.
I know I'm not.
Very broad support on the committee for the judgment that it will soon be appropriate to raise the target range for the federal funds.
Can you guys hear that okay?
The other thing is maximum employment.
Why is it coming? Oh, hold on a second. Whoopsie. Let's try this again. You ready?
Will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may well increase. The level of maximum of employment that's consistent with stable prices may increase, and we hope that it will as more people come back into the labor market, as participation gradually rises. And the policy path that we're broadly contemplating would be supportive of that outcome as well. So the thing about the labor market right now is that there are many millions of more job openings than there are unemployed people. So you ask whether we can raise rates and move to less accommodative and even tight financial conditions without hurting the labor market. I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market. And my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also, fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are highly uncertain, and that inflation has persisted longer than we thought. And
it will
of course,
continue,
we're prepared to use our tools to assure that higher inflation does not become entrenched.
AKA higher inflation is coming.
Let's go to Nick Timrose at the Wall Street Journal.
Good afternoon, Chair Powell. Nick Timrose at the Wall Street Journal. I have a couple of questions on the balance sheet. The statement on the balance sheet today calls for significantly reducing your holdings. What does that mean? And then, apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales, or changes in the composition of reinvestments? Thank you.
We can't pause this, by the way, guys, because it is live. Just letting you guys know.
Those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting.
Guys, drop a one if you think they're going to buy
discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully.
Drop a one if Jerome Powell's buying Bitcoin actively right now.
And those are meant to guide the actual decisions we'll
desk.
make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many. I can't tell you how long it will take. And then, at the appropriate time, we'll provide additional information. So the last cycle when we went through balance sheet issues, we did find that over the course of 2 or 3 meetings, for example, we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to, more of the details that you're asking about. I would say this: the balance sheet is much bigger. It has a shorter
You don't
duration
say.
than the last time.
It's much bigger.
And the economy is much stronger, and inflation is much higher. So, and I think that leads you to.
I love how you said the economy is stronger, but inflation is
being willing
higher.
to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number 1, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So we do want the federal funds rate, we want to operationalize that, and we want the balance sheet to be declining in a predictable manner, and we want it to be declining primarily by adjusting reinvestments.
Yeah, get rid of all those
So if I
trash
could
bonds
follow
and
on
buy
that,
Bitcoin.
raising rates and reducing the balance sheet both restrain the economy, both tighten monetary policy. How should we think about the relationship between the two? For example, how much passive runoff is equal to every
This guy's
quarter
eyes looks like he's done
percentage
about
point
6
increase
lines of blow
in your
before he got on
benchmark
here.
rate?
So again, we think of the balance sheet as moving in a predictable manner, sort of in the background, and that the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs, I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rate increases affect financial conditions and hence economic conditions. Balance sheet is still a relatively new thing for the markets and for us, so we're less certain about that. So again, I think our
He's way
follow
better than
is
Gary
to,
Gensler,
is
though.
to arrive at a timing and a pace and
Yeah, this guy
composition and all
went to
those
BS
things,
school.
and then announce that with advance notice, and it will start in the background, and then we'll look to have that just running in the background and have the interest rates again be the active tool of monetary policy. That's at least the plan. I can't tell you much more about any of the very good issues about size, pace, composition, those sorts of things. We'll be turning to all of those at coming meetings.
Thank you.
Thanks. Now we'll go to Neil Irwin.
There's a lot of dodging and weaving from what I'm
Thank you, Chair
hearing.
Powell. It's Neil Irwin from Axios. Glad to be back. Sir, I was wondering if the volatility we've seen in financial markets in the last few weeks strikes you as anything alarming or that might affect the trajectory of policy. Conversely, to the degree that financial conditions have tightened some, might that be desirable in some ways in achieving your tightening goals?
So, as you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals? So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this. We said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime
At the
later
appropriate
this year,
time,
perhaps.
meaning
We
no
haven't made
time
that
soon.
decision yet.
At the appropriate
So
time. That's what frustrates
we feel
me.
like the communications we have with market participants and with the general public are
Yeah,
working.
we're pricing in the
That
the market
financial
is pricing
conditions
in
are
the
reflecting
rate
in
hikes
advance
that are
the
not
decisions
happening
that
yet.
we make.
But
And
we are still delaying them.
monetary policy works significantly through expectations. So that in and of itself is appropriate.
They've been
There you
saying
go.
0 to
Just-
0.25, and that's what they're sticking with, 0 to 0.25.
Thank
Like,
you. Let's go to
he
Howard
just finished
Schneider.
saying the market works perfectly on expectations. So, AKA, we're going to
But, you know,
feed you
for a year,
BS and give you expectations to
thanks,
move the
Chair
market and say, hey,
Powell.
we're controlling
So for a year
inflation by giving
now,
you
the statements
expectations.
reference the benchmarks for this initial interest rate increase. Now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next step and the next step?
At the appropriate time, we will give you the appropriate rate. Right now,
we haven't gotten to that point. We haven't made a decision yet, and we'll make that decision at the March meeting. We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so.
They want to, but the conditions aren't going to be appropriate, so they're not going to happen
around the world. But we do expect some softening in the economy from Omicron, but we think that that should be temporary, and we think that the underlying strength of the economy should show through fairly quickly after that.
This guy did not even answer one drop of that question.
Just a related question. The December SEPs had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
The path is highly uncertain, and that we're committed to using our tools to make sure that inflation, high inflation, does not become entrenched.
That's exactly what is happening here.
So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation, as I mentioned. Fiscal policy will providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that too should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that
exactly,
for whatever reason, the economy slows more and inflation slows more than expected.
He keeps pointing to the supply chain. AKA, we're not going to do anything. We're just hoping the supply chain unclog, and we can reduce things, can come down and make it seem like we're doing something.
Than existed during the last tightening cycle, and our policy is going to reflect those differences.
If the tightening cycle is anything like the way he ties his tie,
Let's go to Gina
we're in trouble.
Scaling.
Come on, people, bring the heat. Everybody's here stunned. Nobody knows what to ask this guy anymore because he's not answering anything. And we're like, what can we ask him? What can we ask him? Somebody ask about Bitcoin.
Let's go to Steve Leisman.
Come on.
Come on, Steve. Steve Leisman.
Bueller. Thank you, Mr. Thank you, Mr.
Bueller.
Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at next upcoming meetings and you won't begin balance sheet reduction until after you begin rate hikes, it seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of the technical question part of it. The principal question I have is, you said it's going to be running in the background, but the statement on balance sheet principle says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
Get this guy a new mic.
Let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the years during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. And it doesn't mean we're going to, but if the situation turns out to be different than we had thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means of adjusting the stance of policy, that will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate, that will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to describe how we will proceed. But it may be at a higher level, to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first, and then at the appropriate time, start to shrink the balance sheet. Now, the balance sheet is substantially larger than it needs to be. We've identified the end state as in amounts needed to implement monetary policy efficiently, effectively in the ample reserves regime. So there's a substantial amount of shrinkage in the balance sheet to be done. That's going to take some time. We want that process to be orderly.
Stock market up to float.
And
these past 2 years.
So those are some of the ways I would think this lays out our, the way we're thinking about this. In terms of the timing, I can't really help you. It just says after we get underway. So I would say we're going to have another discussion at the next meeting, and my guess is we'll have at least one other discussion at the meeting after that, and we'll tell you as we make progress, and we'll start the process of allowing runoff and shrinking the balance sheet at what we find to be the appropriate time. I wish I could say more, but honestly, we haven't made those decisions, and we.
Once again, there's no volume coming from you, Nick. There's no volume coming from you.
All right, sorry. Just real quick, you're going to see him continue to look down at his page, and I'll tell you why. All of just in pure news media fashion, they all have to turn in, and I've looked into this before, they all have to turn in their answers or their questions in advance so that he's not blindsided by something. Like, they know in advance what he knows about what's coming at him. It's not like somebody just tosses something in out of left field. So he is going to be looking down at notes. Just letting you guys know that.
Yeah, 100%. None of it is live, casual conversation. It's all
important discussions on all of the details that we will have at coming meetings.
And his favorite answer, we still have not determined that. We will continue waiting until the appropriate time.
Chair Powell, good afternoon, Michelle, and Chair Powell, Craig Torres from Bloomberg. Chair Powell, at the beginning of the conversation, you said risks are two-sided. And I'm wondering if you can elaborate on what are the risks to the elusive soft landing? Is Fed policy a risk, over tightening, or what are the risks? And then second, Chair Powell, I have a quick administrative question. Robert Kaplan's disclosure of his securities transactions. In a couple of months, Chair Powell, or maybe sooner, you and I will file our tax returns and we'll list transactions and all kinds of things. And next to those transactions, we'll put dates. And Bloomberg asked for the dates of Mr. Kaplan's transactions. The Dallas Fed is not giving us the dates. And I don't see why this is a matter for the Inspector General or anybody else. I mean, why can't he give us the dates? Will you help us get the dates of those transactions? Thanks.
So
that paint scheme crypto face is called
the
piss
risks
yellow.
First. So the one risk is that inflation risks are still to the upside in the views of most FOMC participants, and certainly in my view as well. There's a risk that that the high inflation we're seeing will be prolonged, and there's a risk that it will move even higher. So
there it is, guys.
And
A
we
little bit of
don't
truth
think
that
that's the
they'll
base
tell you.
case, but you ask what the risks are, and we have to be in a position with our monetary policy to address all of the plausible outcomes, and that calls for us to be in position. We have an expectation about the way the economy is going to be evolved, but we've got to be in a position to address different outcomes, including the one
We have an
where
expectation,
inflation
but we
remains
can't
higher.
tell you what
And
we're
of course,
expecting.
that is a risk
Because
to
if
the,
you did, you shit yourself.
to the expansion. You know, we've been saying that what we need here is another long expansion, which is the kind of thing we saw over the last, which is the record long expansion. We saw labor force participation rise. We saw wages persistently higher for people at the lower end, and there really was no obvious imbalance in the economy that threatened that expansion. It could have gone on for years were it not hit by the pandemic. So we'd love to find a way to get back to that. That's going to require price stability, and that's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal.
But
So I
when,
mentioned
bro,
two-sided
when?
risks. You know, a couple things. One, the COVID is not over, and COVID can continue to evolve, and it's just we have to accept that it's not over, and the risks to it can slow down growth.
The risk to it is that we will continue printing
That's
every
sort
time
of a downside
new,
risk from a growth standpoint.
a new cousin
I would point
appears.
to, you know, another risk is just further problems in the supply chains, which could slow down activity. And you see the situation in China as a situation there where that's their no COVID policy may cause more lockdowns, is likely to, and that may play into
China can't produce stuff, we
more
can't
problems
buy.
with supply chains. In addition, there's what's going on in Eastern Europe and things like that. So there's plenty of risk out there, and we can't forget that there are risks on both sides. So that's there. That's what I would say. I know you've been all over this issue with my colleagues, Craig, on the issue of information. We don't have that information at the board, and I asked the Inspector General to do an investigation, and that is out of my hands. I'm playing no role in it. I seek to play no role in it, and I can't help you here today on this issue, and I'm sorry I can't.
Okay.
Sorry, we have no
Thank you. We'll
answers
go to
for you.
Gina now.
Inflation will continue. China still can't produce anything, and we are
Thanks for
dependent on
taking our
China
questions, Chair Powell,
100%
and
for all
sorry for my
supplies.
tech issues. I wonder if you could tell us a little bit about where your thinking on inflation stands today. You know, the last time we saw an SEP back in September, we saw that you and your colleagues were projecting that inflation would sort of sink back down quite close to
No
target
volume.
by the end of
You
the
don't-
year.
you
And
don't
I
show
wonder
volume.
if you still think that projection
Best looking person to speak so far.
December is a reasonable one, and if your thinking has changed at all, I wonder.
I wonder
how
what
you're thinking about
OnlyFans they
that.
bought her
And I
from.
also wonder if you could talk a little bit about the pathway to getting to that deceleration. Like how do we get from here, 7% CPI, to where you expect to be at the end of the year?
So I'd say, since the December meeting, I would say that the inflation situation is about the same,
7%.
probably slightly worse. I'd be inclined to raise my own estimate of 2022 core PCE inflation. Let's just go with that by a few tenths today. But we're not writing down an SEP at this meeting. But I think it hasn't gotten better. It's probably gotten just a bit worse, and that's been the pattern.
So I don't want to give you the real number.
I think if you look at
because you'll be scared.
the FOMC
But
participants,
I can just tell you it's worse than what you
there's
think.
a range there, and that range has been moving to the right for a year now. And by the way, if you look at other forecasters, essentially all other macro forecasters who do this for a living, you've seen the same pattern. So what do we think about that? Well, I think we wrote down rate increases in the December meetings, each of us individually. And I think to the extent the situation deteriorates further, our policy will have to address that. If it deteriorates meaningfully further, either in the time dimension or
Let me take
in
this back
the
real
size
quick.
of
I
the
just finished saying that it's going to
dimension.
get worse.
So
If
that's how
it
we're
gets
thinking
worse.
about it. As I mentioned, though, I think it's part of this will be that the Fed moving away from a very highly accommodative policy to a substantially less accommodative policy, and then over time to a policy that's not accommodative in time. I don't know when that will be. Those are the things that we're thinking about. That's part of it. Another part of it is that fiscal policy provided an impulse to growth over the last 2 years. That impulse will be less. In fact, will be negative this year, and so that's another thing. The other one is we will eventually.
Hey, Crypto Face, are you actively shorting this news right now, or what's up?
Get relief on the supply side, and the ports will be cleared up, and there will be semiconductors and things like that. Now, what we're learning, it's just taking much longer. So I think longer than expected, and that I think does raise that high inflation more persistent. I do think we'll come off of the highs that we saw in the early part of this episode in the spring last year, but really the question is going to be what is inflation running at, and so we'll be watching that. And our objective is to get inflation back down to 2%. It's also to provide enough support to keep the labor market
not
healthy.
a chance.
The labor market is very, very strong right now. And I think that strength will continue. There's really a shortage of workers. We see it.
Unless this guy create the time machine, we're not going to see 2% anytime soon.
And people in the lowest quartile, you see very large wage increases. I mentioned some of the other indicators. So I think that's what we're looking at. And we're also, we realize, I think, as everyone does, that this outlook is quite uncertain, and that we're going to have to adapt.
Once again,
we're going to communicate as clearly as we can, but we're going to have to be adaptable. And
they keep hinting at it. He keeps hinting at it. It's worse than we think it is. It might last longer than we thought it's going to last. Things are not under control. He keeps hinting at it.
Thank you, Michelle. Chair Powell, when you talk about being humble and nimble about the path forward for monetary policy, does that also include the possibility of raising interest rates by larger increments and, say, doing a 50 basis points hike at some point if inflation does not moderate sufficiently?
Listen close here to this answer.
Should we interpret this approach as a departure from the gradual pace that we saw during the last hiking cycle?
Absolutely not.
So,
that would never happen.
As I mentioned, we have not made these decisions. We really haven't. And what I can tell you now, though, is that we fully appreciate that this is a different situation. If you look back to where we were in 2015, 16, 17, 18, when we were raising rates, inflation was very close to 2%, even below 2%. Unemployment was not at our estimates of the natural rate, and growth was in the 2 to 3% range. Right now, we have inflation running substantially above 2%, and more persistently than we would like. We have growth even in forecasts, even in the somewhat reduced forecasts for 2022. We still see growth substantially higher than what we estimate to be the potential growth rate. And we see a labor market where, by so many measures, it is historically tight. I think in a way, the least tight aspect of it is looking at the unemployment rate, which is still below our median estimate of maximum employment. If you look at things like quits and job openings, as I mentioned earlier, and wages, you're seeing, and just the ratio of job openings to unemployed, you're seeing a very, very tight labor market. Now, we also know that labor force participation is significantly lower. It's 1.5 percentage points lower than it was in February of 2020. Maybe 1 percentage point of that is retirements. Some part of those retirements are related to COVID rather than just regular retirements. So we think there's a pool of people out there who could come to the labor force, but it's not happening very quickly, and it may continue to not happen very quickly as long as the pandemic is on. So that's how we think about that. We haven't made, to your specific question, we really have not addressed those questions, and we'll begin to address them as we move into the March meeting and meetings after that.
AKA, we haven't even thought about raising interest rates that high because we just cannot do that. We cannot slam the brakes on heading down on a slippery slope.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can talk to us about any metrics that the Fed uses to assess how inflation affects different groups of Americans, especially lower income earners. And are you worried that the Fed underestimates or can't effectively measure the impact of inflation on some of the most vulnerable households? Thank you.
So it's
they're just
more
going
a
to suck it
matter
up.
of, I think the problem that we're talking about here is really that people who are on fixed incomes who are living paycheck to paycheck. They're spending most or all of their of what they're earning on food, gasoline, rent, heating their
big screen
things like
TVs,
that, basic necessities. And so inflation right away forces people like that to make very difficult decisions. So that's really the point. I'm not aware of inflation literally falling more on different socioeconomic groups. That's not the point. The point is some people are just really in prone to suffer more. I mean, for people who are economically well off, inflation isn't good. It's bad. High inflation is bad, but they're going to be able to continue to eat and keep their homes and drive their cars and things like that. It's more so that's really how I think of it. And we have to control inflation for the benefit of all Americans, but part of it is just that it's particularly hard on people with fixed incomes and low incomes who spend most of their income on necessities, which are experiencing high inflation now.
He goes, and we don't really think it affects people differently. It sucks for everyone, but if you're poor, it definitely sucks for you.
Thanks, Michelle, and thank you, Mr. Chairman, for taking the question here. So year over year, inflation's at a 40-year high. The input costs for producer price index for all of 2021 was the highest on record. Some investors fear that the Fed might be moving too late. Now, you said no decisions were made on the path of rate hikes, but was a rate hike more than 25 basis points discussed today? And as a follow to that, because I have problems with the mute button, as a follow to that, you testified that the supply chain issues could be worked out by the end of the year. You talked about that today. The CEO of Ford, though, told Fox Business today that the chip shortage will last into 2023. So today you said inflation will start to ease this year. I want to drill down and get a timeline that you see as to when we could see that relief. Thank you.
At the appropriate time.
I would not say that I would expect the supply chain issues to be completely worked out by the end of this year. I do not expect them, and I have not expected them.
There you go, guys.
What I would say, and I have been saying, is that I expect progress to be made in the second half of this year, mainly. Progress, because we're not making much progress. If you look at a ton of metrics, you can find some that suggest that delivery times are shorter and inventories in some industries moving up, but overall, we're not making progress. And things like the semiconductor issue they're going to be quite a long time. I would think they'll go more than through 2023.
Longer than 2023.
So in terms of being too late, I would just say this: our policy needs to be positioned to address the full range of plausible outcomes, as I said, and particularly the possibility that inflation will continue to run higher more persistently than we'd expected.
The most likely.
And we think we are positioned to make the changes in our policy to do that.
Than expected?
And we're committed to doing that. And
yes.
That's really where we are. In terms of your question about
they think they're
size
positioned
of rate increases,
but we don't know when
we
and
haven't
how.
faced those decisions. We haven't made
We'll
them.
let you know at the appropriate time.
It isn't possible to stand here today and tell you with any confidence what the precise path will be. But as we work our way through this meeting by meeting, we are aware that this is a very different expansion, as I've said a couple times, with higher inflation, higher growth, a much stronger economy. And I think those differences are likely to be reflected in the policy that we implement.
So
Thank you. Let's go to Mike McKee.
Supply problems continuing through 2023, chip shortages through 2023.
Thank you, Mr. Chairman.
Continuous inflation
I'd like to sort of
through
weave some of the
2023.
strands of your answers together and ask you, as you start to reverse policy, what your goal is. Are you going to be raising interest rates until you get inflation to 2%? Do you want to go below 2% so that on average you get a 2% inflation rate? And because you said we have to protect the employment part of your mandate. Is there some sort of circuit breaker that would stop you from raising interest rates on the employment side?
So no, there's nothing in our framework about having inflation run below 2%. So that we would do that, try to achieve that outcome. So the answer to that is no. What we're trying to do is keep inflation expectations well anchored at 2%. That's always the ultimate goal, and we do that in the service of having inflation. We get to that goal by having inflation average 2% over time. And if inflation doesn't average 2% over time, then it's not clear why inflation expectations would be anchored at 2%. So that's the way we think about that.
There you go. Guys, he just said it. If you can pause that, Nick, real quick.
What was the last part of your
He literally just said, we're just trying to manage expectations, the expectation of 2%. And if we can't get the expectation of 2%, then we're just going to have to adjust that. It's like they're literally telling you we cannot bring it back to 2%. We're just trying to manage people's expectations. We're giving you a lot of blah, 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 but there ain't nothing coming to help us.
I was asking if you're protecting the employment side of the mandate, whether there's some sort of circuit breaker there.
Nothing like that. I mean, I would say you have a tremendously strong labor market, and you have growth this year at forecast to be well above potential. I mean, people are forecasting growth. If you think potential growth is around 2, most forecasts are significantly above that for 2022, and that's even with policy becoming substantially less accommodative. So the labor market's going to be strong for some time. We ideally, what we're trying to achieve is inflation getting back down to 2%, and we're trying to do that in a process that accomplishes, that will also leave the labor market in a very strong position. And no one really knows what that will take. Again, I would say that it isn't just monetary policy that's helping inflation get down. It'll be supply side improvements, and it'll be less fiscal impulse in all likelihood. So, but monetary policy will do our job. It is our job to get inflation down to 2%, and a situation where the two goals can be in tension is a difficult one. But I don't really think they are here, though, because I think a really significant threat to further strengthening in the labor market in the form of higher participation over time is high inflation. And also, high inflation is taking away the benefits of some of these large wage increases that we're seeing now. So we do hope to achieve, and our plan is to achieve both of those goals.
We don't know how.
I could follow up.
Nobody has an answer.
The danger of tightening too much as policy works its way into the economy with a lag mean that you should go back to being more forecast dependent in making decisions rather than the state dependency you've been using as a framework for the last year and a half or so?
State dependency was particularly around the thought that if we saw a very strong labor market, we would wait to see actual inflation before we tightened. And so that was a very state-dependent thought, because for a long time we'd been tightening on the expectation of high inflation, which never appeared. And that was the case for a number of years. So in this particular situation, we will be clearly monitoring incoming data as well as the evolving outlook.
We've been inflating year over year for freaking ever. What's he talking about?
A lot of BS, a lot of caca.
Hablando mierda.
Thank you for taking my question. I want to ask you, with the benefit of hindsight, and I realize, I mean, that is what it is, but do you feel that, monetary policy and fiscal policy maybe did too much to react to the crisis, and that part of the inflation problem that we're having right now is because the government response, collectively was more than what the economy ended up needing?
I just want to show everybody that there's so much caca being talked in this meeting that Bitcoin is puking its guts out right now. Bitcoin is actively puking its guts out, taking a huge nosedive.
If you remember what it felt like at the beginning of the pandemic, literally the global economy shutting down in large part, including our own economy, and people going to their homes for weeks on end in masks, and there are no vaccines, and it could be a really long time to get them, and then you have economic activity drops by a shocking amount in one quarter. So there was a real risk of lasting damage. And I think Congress responded remarkably with the CARES Act, incredibly timely, very powerful. There'll always be flaws in these things, but in real time, it was a remarkable achievement. And we responded, and what we were able to do was, stave off a collapse of the financial system at the beginning and make time for what really needed to happen, which was the income replacement and then the recovery that Congress enabled with the CARES Act. So now that was a lot. And what we did was a lot. And now, what we have now is we have the strongest recovery of any country, and we have a recovery that looks completely unlike other recoveries that we've had because we've put so much support behind the recovery. And we're managing the relatively high-class problems that come with that, which are high inflation.
I'm going to go lay her down.
So, and these are serious problems, very serious problems that we're working as hard as we can on. Was it too much? Again, I'm going to leave that to the historians. But look, in 25 years, we'll look back at this incident, which will be a 2, 3, 4, 5-year period, and we'll say, we'll have a much better basis to make a judgment about the actions that people took. But it was all founded, though, in a very strong reaction to a unique historical event. And I guess I'll have to leave it at that. I hope I'll be around to see how that looks in 25 years.
In 25 years, we'll look back at this and see
Let's go to Jean
the
Young.
beginning of the death for the U.S. dollar.
Thanks, Michelle. Chair Powell, some investors are expecting the yield curve could flatten or even invert after rate hikes begin. Would that worry you? And how important is that risk in the Fed's consideration for adjusting policy?
So we do monitor the slope of the yield curve, but we don't control the slope of the yield curve. Many factors influence longer-term interest rates. But it is something that we watch, and you will know that from when we had this issue a few years ago. And we take it into account along with many other financial conditions as we try to assess the implications of all those conditions for the economic outlook. So that's one thing I would say. Another is currently you've got a slope, if you think about 2s to 10s, 2-year Treasury to 10-year Treasury, I think that's around 75 basis points. That's well within the range of a normal yield curve slope. So it's something we're monitoring. I don't think of it as some kind of an iron law, but we do look at it and try to understand the implications and what it's telling us. But it's one of many things that we monitor.
Can I follow up real quick and ask if it did invert, would you tie it to U.S. fundamentals, or would it be driven by a much broader set of factors?
That's a good question in real time. Obviously, U.S. long-term sovereign debt is an important global asset, and the fact that our rates are so much higher than other risk-free sovereign rates around the world may put something of a ceiling on our rates. I don't know, but it would really depend on the facts and circumstances at that time.
Interesting. Thank you. Let's go to Brian Chung for the
Very
last
interesting.
question.
Hi, Chairman Powell, Brian Chung, Yahoo Finance. Within the context of just the broad effort to normalize rates, would you describe what you want to do as a gradual hiking? And then secondly, within the context of hiking cycles, it's often the talking point for financial stability and wanting to make sure that asset bubbles don't merge. Is that something that has also factored into the conversation as you start to think about hiking rates? Thanks.
I would describe what we're doing along these lines. This is going to be a year in which we move steadily away from the very highly accommodative monetary policy that we put in place to deal with the economic effects of the pandemic. And that's going to involve a number of things. It's going to involve, and it does involve, finishing asset purchases. It's going to involve lifting off, and it's going to involve additional rate increases as appropriate. And we're going to write down in March our next assessment of what that might be. It's going to continue to evolve as the data evolve. We need to be quite adaptable, I think, in our understanding of this. The last thing we're going to do is we're going to have a couple more meetings, I think, to talk about allowing the balance sheet to begin to run off and do so in a predictable manner. And that's something that we will also be doing as appropriate. And
as the data continues to evolve,
I don't think it's possible
we will see
to say
that we cannot
exactly
continue to
how
increase
this is going to
interest
go.
rates.
And we're going to need to be, as I've mentioned, nimble about this. And the economy is quite different this time. I've said this several times now. The economy is quite different. It's
but we're going to have the
stronger.
same
Inflation
approach.
is higher. The labor market is much
We're going to
stronger
keep kicking
than
the
it
can
was.
down the line.
And growth is above trend, even this year, let alone last year. So all of those things are going to go into our thinking as we make monetary policy. And you asked about financials. Do we have concerns in connection with our policy? Was that your question?
Yeah, within the context of other hiking cycles, it seems like worries about asset bubbles emerging as a result of easy rates has been part of that. I didn't know if that was part of the discussion today.
I would just say this. We of course have a financial stability framework. And what it shows is a number of positive aspects of financial stability. But you mentioned really asset prices is one of the four. So asset prices are somewhat elevated and they reflect a high risk appetite and that sort of thing. I don't really think asset prices themselves represent a significant threat to financial stability, and that's because households are in good shape financially than they have been. Businesses are in good shape financially. Defaults on business loans are low and that kind of thing. The banks are highly capitalized with high liquidity and quite resilient and strong. There are some concerns in the non-bank financial sector still around money market funds, although the SEC is has made some very positive proposals there. And we also saw some things in the Treasury market during the acute phase of the crisis, which we're looking at ways to address. But overall, the financial stability vulnerabilities are manageable. I would say.
Very good point over here. Very good point.
Thank you.
So there you have it, guys. There you guys have it. It's over. What do we get from this? All we got was uncertain. We will let you know at the appropriate time. Supply chains. We're heavily depending on supply chains to get better so they can help us with inflation because interest rates are not going to be raised as people expect. We're just trying to manage expectations. When our supply chain is going to get better? Most likely not this year. Most likely we will continue to have supply chain problems into 2023. So therefore, meaning they also mentioned a lot that we're preparing for all scenarios. And the most likely scenario, which they kept hinting at here and there, is more inflation, continuous inflation getting higher, and just managing expectations. We will have more meetings about this. We will continue to try to manage expectations as we hope for supply chains to get better to help us reduce inflation. But in reality, there's not much done. It's a big nothing burger. Nothing is changing. The interest rates will not continue to be spiked, right? They asked if they're gonna have a 0.50, and he literally said, he didn't reply. Then this wasn't his reply, but he said later in the meeting that the other countries around the world have such low interest rates that might actually be putting a ceiling on how high the interest rates can go for the United States. So a few countries actually have negative interest rates around the world. We are basically at zero. We cannot go a lot higher than the rest of the world. So it's literally capping us on how high we can go. And if we can't continue to raise interest rates, what's going to happen? We're going to continue seeing inflation. This 2% inflation rate, they kept talking about an anchor. He's literally just using a mind trick to keep you at 2%. He never talked about the actual real number of inflation. He never actually mentioned the number. He just said, yeah, we're a lot higher than 2%. We're a lot higher than 2%. We're going to try to get back to 2%. Psychologically telling you 2%, making you think it's a lot lower than what it really is. But in reality, we're nowhere near 2%. The real numbers are a lot higher. And all he could say was, We don't have an answer right now. We will have an answer at the appropriate time. We don't have a plan on how to do this, but we will at the appropriate time. When's the appropriate time? When the dollar's on fire and burning and we're using it to heat up our houses during the winter? When's the appropriate time, right? What's the actual plan? They have nothing for us. Nothing. What do you think, Nick? So what are you taking away from this entire meeting?
Is this plan? Hold on a second. Is this plan over?
Pandemic and the reopening of the economy.
Yeah, it's over.
We remain attentive to risks.
It is? Okay. All right. All right. Sorry. All right. Cool.
So what do you think from this meeting, Nick? What do you think is from everything you heard? What's your mental recap of it?
My mental recap, first of all, is that my co-host over here had me a little bit sidetracked, right? But no, I said yesterday on Around the Blockchain, right? Oh, side note, is that good to go, Miguel?
What's good to go
for this afternoon?
Maybe. Not confirmed yet.
Es posible? Okay. Well, then I won't throw it out there. Okay. Well, you know what? There's 52 people on here. Guys, watch Around the Blockchain tonight. Miguel might just be on there this evening. We're waiting for confirmation. That just might be happening tonight. So you want to see if you want to see BlockchainCrusader on Around the Blockchain tonight, drop a 1 in the chat. Gonna bring that heat, bring it home for Debate Crypto. Okay, but what I was getting at was I think that on Around the Blockchain yesterday, they asked to fill in a word for, I know you missed it yesterday. They asked us to fill in a word for what we were going to feel after this meeting. And my word was irritated, right? I either said irritated or frustrated. And that's how I feel right now. I told you before we got on here, like they said, no change, no this, no that. Listen. I understand that we're talking about economic policy. I understand that it's a house of cards at this point, right? I think that's probably the biggest thing. They understand with how things are stacked. It's like Jenga with like just one piece. If you pull that wrong piece at the wrong time, it topples. But they knew that they were pressing us towards this when we started printing trillions of dollars, right? You just had to, right? Now, I'm not saying that we wouldn't have got here anyway, but the reality is,
we've been in this trajectory for the last 100 years.
I believe in the long grand scheme of things. What I see is that the pandemic gave them an opportunity to point, and I've talked about this a little bit before. There's the problem. This is why we did this, when in reality, I do believe that the Great Reset was in the chamber, like on their hip, ready to pull it, right? And now this gave them the ability to say, hey, look what happened. Here's why it happened. Now we can move to a digital dollar. Now we can monitor what you guys are doing. Now we can be very, public about what, like, you know what I'm saying? Like they're ultimately just saying, hey, we need a different system, but it was already broken to begin with. And so though I love cryptocurrency and I think that it can be and is an answer for this, I think that this has given them the opportunity to do exactly what they're doing right now. Play games with us, play games with the fact that, hey, you know what? We do actually like have a portfolio that matters to us, right? We're not playing with other people's money or money that we've got so much of that it's just like, whatever, right? This stuff matters, and fear matters in these markets. So it's irritating. I mean, it's irritating. If you're going to kick the can down the road, tell us you're going to kick the can down the road. If you're going to make a big change, tell us you're going to make a change.
I mean, they're telling us, right? But they tell us the way that we don't like it. They tell us by, giving us that little reach around. They don't want to tell you directly to your face that they're kicking down the can on the line, but they are, because they keep talking about how they don't have a plan. We need to continue discussing this, and we will let you know at the appropriate time. Thank you for the super chat. Greatly appreciate it.
Thank you, Heidi. I appreciate you.
Like, it's just this constant thing of like, we have no answers. They even mentioned that the fact that all the other countries around the world have such low interest rates or even negative interest rates, that could actually be putting a ceiling on how high our interest rates can go, right? They can't just drastically be a lot higher than the rest of the world if the rest of the world cannot keep up.
Because we're the reserve currency as of now. Yes. But then that gives us also the opportunity again for this idea of this great reset that we all talk about. When people tell me I've got a tinfoil hat on and that, no, like we don't. Something has to change, and at some point it crumbles. At some point this falls apart, whether it's from hyperinflation, or whether it's from a screeching halt because they push us into a hardcore deflationary state, which brings stagflation and the country stops. Either way, we are in trouble, period. We just are.
Yeah, I mean, it's either depression or hyperinflation. It's one of the two that's going to happen, right? And they don't want depression because, you know, Bezos and all the big guys, they don't make money in a depression, right? Ain't nobody lining up and ordering things from Amazon when there's a depression and you're on the breadline. That's just not going to happen.
They'll be the only ones that are making any sort of real money. All the small businesses will be screwed. It'll be bad. It'll be bad for sure. But hyperinflation will do the same thing. It'll just all be bad, man.
Yeah, I mean, it'll all be bad. But hyperinflation, like I've always said, is easier to manage, right? You can slowly have the money supply continue to print, continue to grow, right? They can slow inflation by slowing down the money printing, but they can't stop. We're on a one-way course. There is no reverse here. There is no hit the brakes. There's just a let's slow down, but there's no stopping this train of inflation that we're on. It's just, it can't happen. That's why they keep saying all we're here is to do, we're to manage expectations of inflation. You know, we're going to continue discussing and let you know at an appropriate time. As data evolves, we will figure out when is the appropriate interest rate hike, when it's going to happen. They have no plan. They can't.
Yeah,
they're just managing the crowds.
Yeah, and Jack's right. They went out of their way to avoid real inflation numbers. But let's be honest, CPI is not real inflation numbers either. The consumer price index is not real inflation numbers. When they tell us 6.5%, 7%, guys, all you have to do is be a consumer at this point and look around. I'll give you a great example, right? Netflix. Okay. Yesterday, turn on the TV. I get a boop, another notice from Netflix saying, hey, the price is raising yet again. Right? Just confirm that you understand the prices are rising yet again. Netflix has had like at least 3 price hikes in the last 18 months, maybe. And so what I'm trying to get at is the gas pump, huge price hikes, the grocery store, huge price hikes, and you can't get what you want kind of at this point, right? You go to any sort of the freaking shoe store, price hikes, like anywhere a consumer goes right now, price hikes, and they're not 6.5% or 7%. They're 20, 30, 40, 50. Check this out. Lumber. I own a construction company. I talk about that off and on. And I just got word from one of my Finnish carpenters yesterday. He gave me a number on some lumber that I was paying for. Well, the store said, hey, here's the number, you know, and I had to pay for it. And I said, man, I paid for it. And I got off the phone and I was like, man, that number seemed high. And I said, wait a minute. And I made a phone call to my Finnish carpenter. He's like, oh, well, you haven't seen? I mean, the prices on maple, the prices on, and he starts rattling off the prices on standard 2x4s. They've gone back up again, right? And prices on lumber are exponentially going back up again. Guys, we're in trouble, right? And so, yeah, the kicking the can down the road will work a little bit, but I think the reality is people are hip to the game now, and social media, because it's so there's so many smart people that are able to have a voice at this point, which is why they want to censor us, that on almost any policy you have enough people that have their eyes open at this point that truly understand what's happening to say, hey, wait a minute, where we didn't have that before in the past. When I was growing up, you listened to the news, right? The news was where you got information. Now you get information from social media, albeit that some of that information is bad, no doubt about that, but you have to deduce from looking through a whole bunch of different pieces of information and where they come from and what that person's credentials are, what are their motives, this, that, and the third, right? And my problem with listening to, you know, like a meeting like this, we need to hear it because ultimately people are making financial decisions based off of the information that we just got. The problem is they set us up for this, you know, hey, we've got a big meeting today and people get amped up and it's going to go this way. It's going to go this way. And then they basically tell you, hey, yeah, we're not really sure what's going on here because worry about it later. And that's really what it is. It is worry about it later. I dropped in the chat earlier when I was when my life was a freaking train wreck, right? When I was actively using, my literal motto, and I would tell people this, was like, Worry about it later. Didn't matter what it was. Worry about it later. And that's where we're at right now. It's literally exactly where we're at. Worry about it later. But guess what, guys? Later shows up. At some point, it's time to pay the piper. That's what we need to truly, truly, truly understand, is that at some point, it's time to pay the piper. And when it is time, if you've worried about it later for long enough, I can tell you from personal experience, it gets ugly fast and it hits hard. It hits hard, right? So I don't know. I just, I'm interested to see what happens here. I'm interested to see how the crypto markets respond. Actually, if you give me 1 second here, I will pull up. Let's pull up a little bit of, let's pull up Trading View, take a look at Market Cipher, see what's going on over here. Bada bing, bada boom. Let me share my screen. Boom. And let's see here. All right. So let's check out Market Cipher, guys. All right, cool. So I was just going to take a peek at Market Cipher real quick. We are on the, let's zoom out to the daily. Let's see what this is looking like, right? Whoop, whoop. All right. All right, so we got a double green dot on the daily, which I got to tell you guys, there is, you know, this on the daily, right? This right here. If we zoom in on this, right? If we zoom in on this, that's you know, nice little move, right? We're moving
4
back
green
up.
days.
That's right. We're moving back up in the right direction, right? Now let's click over to, let's see what the 4 hours looking like. Okay, the 4 hour. If we let me kind of open this up a little bit. The 4 hour here is, look, and actually I'm gonna zoom in even more. Let me go to the 1 hour. So the 1 hour here, let's look at this. All right, so check this out. So right here, right? Boom, 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 boom. And guess what? This is all leading up, leading up, leading up, leading up, leading up. If we turn these to Heiken Ashi, watch this. Boom, boom. Check this out. Leading up, leading up, leading up, leading up to the news. I mean, dude, what can you say, right? I mean, and Market Cipher
had a massive pump when they were talking about the interest rates not being changed, and then after that, just massive dump.
But check this out, dude. 19.44 on the RSI right now. We're at 19, right? So that, you know, we're incredibly oversold right now. And that is coming from, I'll show you exactly where, look, we're at 19 because of this right here. I accidentally circled that green candle, but it's really this right here. We're at 19 because of that. And then look, the good news is on this, guys, look, we had a nice little wick down to 36.7 and the bulls said, and started to bring it back up. Let's look one more. Let me erase these. Let's look.
Yeah, I just feel like we're in dead cat bounce city right now.
See, now look at the 30-minute. And that, see, so I like what CryptoFace does when he actively trades. He literally goes through, and that's why I have all these these 1 minute, 3 minute, 5 minute, 15 minute, and he goes through all these times, and it gives him a, hey, where am I at right now? So right now, all the way to the end of the day, right, or daily or whatever. So if we go to the 30-minute, okay, not looking so hot. We go to the 15-minute, ooh, not looking so hot. We go to the 5-minute, well, okay. Let's go long, baby. No, I'm just kidding. Yeah, guys, it's just yeah, the daily, cool. We definitely need, and I've got the Heiken Ashi on there. That's why you're seeing that. But we definitely need some other movement. So that's
So we got a great question here from Dean. He says, "What's going to happen in crypto now?" Well, I'm going to tell you what's going to happen right now. What's been happening? We will continue to see whales buy up Bitcoin. Bitcoin's supply will continue to stay illiquid.
Is that my baby or yours?
That's my baby.
Now we both got babies crying.
So Bitcoin supply will continue to stay illiquid. The whales will continue to buy up Bitcoin from the weak hands. The weak hands will continue to panic sell, thinking that all this scenario is going to change. That it's over for Bitcoin. We keep saying that it's different this time, that we're into a bear market now. We're at a bear market, but we are at the highest amount of illiquid supply for Bitcoin ever that we've ever seen in any bear market before.
The on-chain metrics don't show that. You're
exactly right. In the on-chain metrics, when you see in the bear market, you see people dumping Bitcoin onto exchanges, dumping. What have we seen right now? People taking Bitcoin off exchanges more than what's going on onto exchanges, and whales just eating up Bitcoin. and the illiquid supply continuing to grow, yet price is dropping. So it's completely backwards right now.
Yeah. Guys, drop a 1 in the chat. I'm interested to see what the chat thinks here. Drop a 1 in the chat if you think that we are going to, over the next week or so, and I love this comment, Jack. Baby must have just checked their portfolio. That's fabulous.
Yeah, she saw the portfolio and said, "Oh,
especially if she hadn't checked her portfolio since November, right?" And then absolutely, just absolute tears, right? But drop a 1 in the chat if you think that we still have room to run. If you still think that, let's put it this way: if you still think we're headed towards 100, if you don't think that we have hit the all-time high as of this year, if you don't think that 69K was the top, drop a 1. If you think we've already been to the top and we're gonna play whatever reindeer games we have in between, drop a 2. So drop a 1 if you think we haven't hit the high yet.
Yeah, I'm gonna answer that question the way Jerome Powell does. We will hit the top at the appropriate time. We will continue discussing this, and we will see as the data continues to change that at the appropriate time, Bitcoin will hit the top.
Dude, that was listen, and I want to say this, we're probably going to see, I'm just guessing, right, from the chat. I'm going to guess we're going to see a lot of 2. Well, we've got some 1s so far. I'm going to guess that we're going to see quite a few 2s right now. The overall sentiment of the market is very bearish, but Miguel, you brought up a very, very, very good point. Not just the illiquid supply, the points at which some of these whales have been buying, right? The illiquid supply is huge. The actual on-chain metrics for the amount of wallets holding for short, medium, and long periods of time, all of the metrics say bullish. So why are we so bearish? And so my thought process is only
manipulation.
Right, it's that. And we are so chained to the stock market right now, and the stock market has been absolutely down, and socioeconomic issues out there are absolutely play a part in this, right? Everyone always likes the idea that that Bitcoin and cryptocurrencies are this hedge against the rest of the world. Well, against the rest of what's happening. Well, at least in the short term, it's not. We respond the same way, right? We just seem to recover a little bit faster. And so
that's important, because even gold.
I know. I know it's huge. I know it's huge. And actually Ben said it yesterday on Around the Blockchain. He said, can we just have some disaster happen so we can hurry up and hit the bottom? And I don't know that I disagree with him, right? All this farting around and playing around and hopium and then dump, and then it makes people angry, right? We know that the crypto markets are very, very tough, right? We know that they're very, very volatile. We know all that. But the little games in between that we can tell are being played because they don't line up with the on-chain metrics are probably what I think makes people the most just irritated with how things, are playing out. That's just kind of my 2 satoshis on it.
Yeah, man, it's just the same BS over and over being spewed, just kicking the can down the line, just dodging and weaving the questions, right? Not really answering, not really giving any answers. They've literally admitted they have no plan. We're continuously looking at the data as it evolves, and we're going to have to keep having meetings to discuss what we're going to do, how we're going to do it. We're looking at all scenarios, but all the scenarios are pretty much leading to inflation, right? The more likely scenario is inflation. Why? Because we are highly dependent on supply chains getting fixed. And then they said, well, but China is having a zero fog around the world policy, which is really putting a damper on things. Therefore, we're going to continue having supply chains until 2023, like into 2023. I do not expect supply chains to get any better in this year. Literally said it. Therefore, meaning if their hope of supply chains don't get fixed, and they're not expecting it to get fixed, they can't really do much. They're admitting that there might be a cap on what they can do when it comes to interest rate hikes because of the rest of the world. We're going to see more inflation. They're literally telling us without telling us. Tell me there's more inflation coming without telling me there's more inflation coming. That is exactly what this meeting was.
Yeah. J-Dub, I want to touch on this real quick. So J-Dub says every major investment bank is getting involved in crypto. Rappers are advertising IDOs. Who else is going to buy right now? Retail is tired. We need retail to be motivated to go up. And let me just kind of correct one little piece of that. So I agree with you on everything that's said there, right? But who really needs retail to be motivated is the freaking whales that want you to buy their bags, because the reason that blow off tops happen, right? And who knows if we've already had ours, as per, you know, Shiba and all these meme coins maybe ate up some of that blow off top. We've talked about that a little bit, but the who needs that blow off top, and those blow off tops happen because retail starts to FOMO, and there's so much excitement built up that the retail chases those green candles. But I got to tell you, it is the whales that need retail to get that FOMO to really buy up the rest of that price action, because they will sell to us. That's why they call smart money versus, quote, I hate it called this, but dumb money.
Yeah, right now they're just buying away. They're taking away all the crypto that we've invested into these past couple of years that they didn't have, right? They're just buying up everything they can and hoarding as much as they can.
Opportunities.
While feeding us the fear of the markets are going to crash. It's all over for crypto. The burst of the bubble, yada, 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 right? They keep talking about all these things. We've even mentioned about, you know, altcoins, 99% of altcoins dying. Yet we see Grayscale adding more and more altcoins to their index, right? Adding more altcoins. So, and they're buying up more supply. And then we're seeing Rothschild investments, or whatever they're called, buying up a lot of Grayscale trusts. So why is this happening, yet Bitcoin and crypto is entering a bear market? This is the beginning of the bear market. Why would they be buying at the beginning of the bear market? Wait for the bear market to really take place, for the markets to really drop, then buy up, right? Why are we seeing more and more illiquid supply for Bitcoin? Why more Bitcoin not on exchanges?
Yeah,
Why?
There's a lot of questions. There's a lot of question marks.
Yeah, they're literally hoarding up the crypto so that we can sell it off to them, so that 8 years down the line from now, when they establish crypto as a safe investment strategy, because they own the majority of it and retail's basically out, they can sell it back to us as this wonderful miracle investment.
Yeah, let me touch on something that I touched on the other night, guys, real quick. Just kind of 3 targets if we do head back down, and I'll be brief on this. The 3 targets really to watch, in my estimation, again, as always, not financial advice, right? But the 3 targets to watch that I believe are really important are 30, 25, and 20. And I'm going to tell you why. Not just because they're nice round numbers, and it's not exactly 30, 25, and 20, but about 30 is because it's a nice big round number. There's a lot of support there, and breaking 30 is actually takes us out of that long-term upward trend, right? So that breaks that. And then if we break 30, I believe 25 is the next number that would be likely, because there's a CME gap there. That's the Chicago Mercantile Exchange. For those of you that are new, there's a CME gap at about 25. I think it's like 25.3 or something like that. And then if we break down through that, guys, previous all-time high is right at about 20K, right? As a general rule, we don't break down back, don't break back through that barrier. However, there's nothing to say that we can't. And I want to remind everybody in here, not being bearish or anything else, just to understand that crypto and these markets, they don't care about you. And the way that we continue to win over time, and Miguel and I have, and many other people have, has been to be patient and hodl, right? I mean, did I take some profits recently? Yes, but like 5% of my portfolio. It was literally nothing, right? In the grand scheme of things. And so what I want to remind you is that Miguel and I had underwater positions for years, right? For years, for what? Almost 2 years, Miguel, I guess probably it would have been about 18 months anyway.
Longer for me. Since 2018. We didn't, and then 2020 was the beginning of the
right,
whole fog around the world.
The dump there, yeah.
Didn't have a real green position, until like late 2020, 2021 kind of time.
Yeah, and so what all I'm trying to get at, guys, is that if you got into this for a reason. And I heard somebody earlier today on one of my live streams in TikTok, I think, said that they wrote down their mission statement as to why they're in crypto. And I was like, man, like I have written down on my refrigerator downstairs, I have written down retire by 2030. Now, am I planning on actually retiring? My wife always laughs at that. She's like, I know you better than that. You're not actually going to retire. Well, you know what? I want to have the ability to do that. I want to have the ability in 2030, that's 8 years from now, to look at my daughter, who will be 8.5 years old, and say, baby, what do you want to do? Where do you want to go? And what, you know what I mean? Like that, I want to just have that full on freedom. And part of that is going to come from patience in these crypto markets, right? But having that goal written down is something I see all the time. And when one of my followers said that today, I was like, man, I need to remind people of that. Why did you get into crypto? And if you got into crypto to make a quick buck, if you got into crypto because you thought it was your lottery ticket opportunity, I hate to be the bearer of bad news, but that's not what this is. Crypto is tough, right? But it's not at the same time, because the people that have won long term, not talking about the 1%, 2%, 3% of traders who are actively doing well like crypto fakes, right? Those are the outliers. I'm talking about your average person that is able to command and bring home life-changing opportunity, life-changing money. Guess where that came from?
Diamond hands, baby.
Buying and holding.
Buying and holding, buying and holding. The crypto markets will crush you, chew you up, and spit you out like the Titans from Attack on Titan if you're here for the short term. If you're here for the long term, you can make it through the pain, right? You can make it through the pain, and the promised land is on the other side of this. It's gonna take you a while to get there, but it's a thing about time in the market. If you're here for the short term, you're not going to make it.
Yeah, and Sean, this is another great point, man. They don't want the economy tanking before midterms. You know, it's sad to say,
yes, sir. Exactly.
But our fearless leader right now cares about one thing, if you ask me, and one thing only, and that's continuing to keep power and be able to make decisions and essentially, push us around, right? Tell us what to do. And if we don't do it, we're going to be shamed into whatever. And
I disagree, Nick. I completely disagree. I don't think he's out there making any decisions. He's just he's out there being pushed.
Let people take us in doses, right? Before they get to the tinfoil hat, we got to let them take us in doses, right? And crypto fam, listen, tonight is What If Wednesday. Okay, so just as a reminder, we have actually, oh, you know what, Alex isn't I've got that scheduled, by the way. But so What If Wednesday is tonight. I can't tell you the topic yet, but What If Wednesday is going to be awesome. It's where we kind of put on, not even a tinfoil hat, we just talk about what if, and we have some really good topics. Probably my favorite of the topics is what if the CIA created Bitcoin. I always bring that one up because it was such a fun one to do. But topics like that. But also, so that's tonight. Thursday night, tomorrow, TA Thursday. So tonight, 9 o'clock, tomorrow, 9 o'clock. And we're going to play around. We might try an 8 o'clock stream, whatever. But at any event, for right now, until we tell you differently, 9 o'clock tonight, 9 o'clock tomorrow night. Sometimes we do get in a couple minutes late. I'm just letting you know now. We're trying not to. And then Saturday night, guys, Miguel and yours, I was about to say yours truly, that would be me. Miguel and your boy, Zach Rector, right, are doing an actual debate. When we started this channel, it was Debate Crypto, right? It still is Debate Crypto. And you guys love when Miguel and I banter back and forth. We're going to actually have a structured debate. I'm going to be the moderator. Miguel versus Zach Rector. And let me see, who's the first person in the chat to tell me what the topic is going to be? Just a broad topic. It's BlockchainCrusader versus Zach Rector. Somebody in the chat, tell me right now what the topic is. I'm going to give you about 10 seconds to somebody tell me what the topic is. 10, 9.
If you know who Zach Rector is and you've been watching this show long enough, you would definitely know what we're going to be debating.
4. Come on. Somebody's got to hit it. 3. Come on. Somebody, hey, listen, somebody in the DCA dojo has got to know what this topic is going to be, because I know they know Zach and I know they know Miguel. There it is. Jason Robertson. I knew it. Hit it. Winner, chicken dinner, XRP. You guys know Miguel is an absolute XRP hater. Zach Rector is an XRP maximalist, right? And so, yeah. Hey, listen, I'm going to be real,
Strike hard, strike fast. No mercy, baby.
I'm going to be real, Miguel. I think it's going to be a very good debate, and I'll tell you why.
It definitely will be a good debate.
Because his whole thing is XRP. So like it would be kind of like him trying to well, you talk about a lot of altcoins too. It would be like him trying. It would be like you trying to debate Pomp, right? Who's like a Bitcoin maxi, right? You're trying to debate an XRP maxi. So he is, I mean, I just think you need to be ready.
Well, I don't
think he's going
expect
bring
him to
some
change
heat.
his mind. And I don't think he
Oh,
ever
no,
will,
that's
right?
not going to happen.
That's
But
not
I
going to
think
happen in this debate. But the crowd
business
will
partner
know.
or not, I'm voting for Zach Rector.
Oh, I know. I mean, the cult mentality is hard to fight, right? Once you go to the dark side, you don't come back.
Oh my gosh. Yeah, so that's going to be awesome, guys. That's going to be Saturday night. So make sure that you guys are there for it. We got anything else in the chat, Miguel? Anything you want to chat about before we call it? Crypto fam, check it out. We appreciate each and every one of you. If you're not already subscribed, please subscribe. We have a lot of fun over here on Debate Crypto. Again, you're going to be seeing debates, TA Thursdays tomorrow night. We're giving somebody a free year Market Cipher, guys. It's worth like $1,000. If you guys don't know who CryptoFace is, he created Market Cipher. It is freaking dope. It is actually here. I'll show it to you real quick. I'll click over to it. Miguel, you want to click over to my screen? You see these green dots on here and these money flow and momentum waves and all of this stuff right here. We'll get into it. We pull it up all the time, but it works, guys. It's a great indicator. We're giving that away for somebody for free. All you got to be is subscribed here and a member of the Academy. So all of that info is down below. Debate Crypto Academy, also known as the DCA Dojo. Sensei Miguel and Sensei Nick in the house. So yeah, guys, we appreciate each and every one of you. If nobody's told you before today, we love you. We hope you have a blessed day. And until next time, hodl.